Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So I came across a fascinating piece this week written by Natasha Sarin, she of the Budget Lab at Yale fame, which she runs. That lab has become the go-to source for the impact of tariffs and all things related to the federal budget. In this piece, she writes about two economies. No, not the two I've talked about for years, the advantaged and the disadvantaged, but AI and everything else. It's mostly a cautionary tale, how AI investment and hype is masking subpar growth everywhere else, how AI is crowding out investment elsewhere, and how AI may drive large-scale labor force displacement. It's not exactly a pick-me-up, but it's a worthwhile read. This week, our three things are: 1. Cycle turn. Lots of press this week on credit deterioration. How real is it? 2. Big bank credit color. It's an important counterpoint to our first thing. And 3. Oil's price drop. That's good for consumers and businesses, right? Well, all right, let's dig a bit deeper. Cycle turn. Leave it to Jamie Dimon to produce the quote of the earnings season for the largest banks. When asked about high-profile corporate credit deteriorations on JP Morgan's Q3 earnings call, he warned that when you see one cockroach, there are probably more, and so everyone should be forewarned. Now, for those of us that have been through a credit cycle or 5, this is consistent with tried and true late-cycle credit truisms, such as, there's too much money chasing too few deals, or Warren Buffett's classic, only when the tide goes out do you discover who's been swimming naked? Or this, from Howard Marks, the worst loans are made at the best of times. Well, here are some grounding observations. 1. Deteriorating names popping up lately include a subprime auto lender, an auto parts manufacturer, an upscale department store chain, and an LNG infrastructure company. These are all idiosyncratic stories featuring some combination of deficiencies in business model, strategic execution, and/or capital structure. There is no evidence that there is some outsized credit concentration out there that has been poorly underwritten. 2. Credit is a risky business. Those firms that find themselves at the riskiest part of the credit spectrum, those that feature the above-mentioned characteristics, are particularly vulnerable to changing market and economic conditions. A handful of high-profile credits deteriorating significantly is to be expected. It would be unusual if this didn't occur. It's called the credit cycle. 3. The macro environment, though far from perfect, as we will elaborate on in a minute, has improved, which bolsters cash flows, broadly speaking, and keeps financial conditions easy, both of which tamp down default rate expectations and fears. And 4. Underwriting standards will tighten as a result of the recent news flow. Mr. Dimon mentioned recent developments caused JP Morgan Chase to scour all process, all procedures, all underwriting. It's better to have that take place now when growth is at or near potential than in an environment where recession probabilities are more elevated. Are there cockroaches in the credit market? Sure, there always are. Is there an infestation? We don't see it. All right, on to our second thing, big bank credit color. Bank earnings releases, like any other company's earnings release, are backward-looking. But one element, credit quality disclosure, contains insightful forward-looking data, including the loan loss provision, or reserves set aside out of current income for what management believes will be future loan losses. It's a number that is part of an essential process vetted by internal and external auditors, multiple regulators, and, of course, investors. It's also the number that swings the most in changing economic conditions. So what did the latest bank earnings releases tell us? Well, apart from Jamie Dimon's cockroach declaration, we learned that all is well in bank loan portfolios. Now, we should mention that banks overwhelmingly lend to bankable customers, meaning higher quality. So their results don't give a comprehensive view of what's happening broadly across the economy, but we get a useful look nonetheless. Across the largest banks that have reported, that would include JP Morgan Chase, Bank of America, Wells Fargo, Citigroup, and PNC, the loan loss provision, which does set aside reserves for existing as well as new loans, declined in the case of 4 of the 5 banks. The same is true for the overall level of loan loss reserves as a percentage of loans outstanding. Only JP Morgan Chase boosted its loan loss reserve to loans over the past year. And by the way, that increase, which was close to negligible in terms of its overall level of reserves relative to loans outstanding, was driven by credit card growth and a couple of instances of apparent fraud. Now think about that. Growth has slowed, rates are restrictive, and policy uncertainty remains elevated. And yet credit quality, at least as far as the largest banks are concerned, has not deteriorated across the whole of their portfolios, remaining at quite favorable levels. According to JP Morgan Chase, consumers and small businesses remain resilient and slightly better than expected. Management lowered its outlook for credit card losses in 2025 from 3.6% given in Q2 to 3.3%. Bank of America mentioned improved outlooks for both credit card and commercial real estate. The broad message we need to send to people right now, management leaned in, is the credit portfolios are performing very well at this point. Pretty definitive. At Wells, credit remains strong and continued to improve. You get the picture. Among higher quality borrowers, both consumer and commercial, this is really close to as good as it gets. All right, on to our third thing, oil's tailwind. So the price of oil continues to drift lower. From its recent peak at the outset of the Russia-Ukraine war, when WTI reached $124 a barrel, the price of oil has fallen steadily through $60 this year. The reasons, as always with oil, are multifaceted. Slowing global growth, the rise of clean energy, increased production on the part of certain state-owned oil producers, and more recently, slowing global trade have all put downward pressure on the price of the commodity. The effect on risk markets is complicated. In the U.S., a fall in the price of oil is often referred to as the equivalent of a tax cut to consumers and businesses. Researchers at the Federal Reserve found that a 10% drop in the price of oil raised U.S. real GDP by around 0.1%. The authors did note that the effects of a move in the price of oil is asymmetric, and that oil price hikes hurt growth more than the benefit of oil price declines. It's also worth pointing out that the cost of energy typically accounts for about 3 to 6% of a household's disposable income. Psychologically, we all like drops in the price at the pump, but that drop is typically not all that meaningful. What is meaningful to markets is what a fall in the price of oil suggests: global slowdown. This week, the IMF released its quarterly World Economic Outlook, where it updated its 2025 global growth forecast to 2.6%. That's Q4 to Q4, down from 2.7% forecast back in July and down from 3.6% forecast a year ago. The latest figure would be the slowest growth rate since the GFC, excluding 2020's COVID year. A sub 3% reading typically only happens when the U.S. is in recession. That does not seem to be in the cards in 2025. In fact, the IMF boosted its forecast for the U.S. in 2025 to 1.9% from 1.7% in July. But back to the oil story. While the drop in oil is generally welcome news to consumers and businesses, there is an inflection point that, when hit, the price drop triggers a risk-off move in markets. That's when markets are concerned that slowing global growth is overwhelming any benefit of the price drop. We may be approaching that inflection point. The current downdraft in the price of oil squares up with the IMF's observation that, quote, uncertainty about the stability and trajectory of the global economy remains acute, unquote. It adds that today's landscape is marked by greater protectionism and fragmentation with dim medium-term growth prospects. Now, the IMF does expect a rebound of sorts in 2026 to 3.3% for the world, presumably on the back of reduced trade policy uncertainty and ongoing technology capex. But it is quick to add that risks remain tilted to the downside for the reasons just mentioned. So there you have it. 3 things in credit. 1. Cycle turn. Weak credit goes bad from time to time. That should not be a surprise. 2. Big bank credit color. Credit here is remarkably strong. And 3. Oil's price drop. It's a good thing, but is it warning of slowdown? As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research, including a piece on First Brands and my newly released Forward Look U.S. Credit Insights Outlook for Q4, where we lay out our macro forecast and what we think you should be watching in the fourth quarter. And finally, for those interested in what's going on with banks, you'll want to attend our KBRA Bank Symposium one day, November 19th in Washington, D.C. I'll be there. You can register on our website. We'll see you next week.